your allowing me to present. I always have a good time here, and I think the crowd likes it too, hopefully. I've adjusted this particular presentation that has really been getting some great response. Just wanted to, because of the Fibonacci Elliott theme that we have. I do use Fibonacci from time to time, and it really dovetails perfectly into using limits, the magic of limits for prop trading success. And I have been in this business for 4 decades. The first 2 were all about managing professional traders, commodity trading advisors, stock managers, and so on. I've worked for Payne Weber. I used to run the largest option firm in the country back in the 80s. And I have a lot of experience with dealing with trading plans. That was the first 2 decades of my existence in the business. And in the last 5 years, though, I have really focused here on this prop trading finale. I mean, I just think it's the best thing that has happened to the retail trader since, I guess, exchange traded options or micro contracts in the futures. But this is it's very lucrative when you do it right. And I'm going to show you some real tips that you can apply right now to help you in your prop trading, because you got to handle it a little bit differently than you would normally handle your retail trading. I'm going to go through that. This is really part of a master series that I'm putting together on how not to blow out your funded account and actually start collecting consistent profits. This is the beginning of the first piece, and I'm going to give it to you today because it really has it's one of the most valuable pieces in the series. Again, I've spoken on countless domestic and international stages for the last 4 decades. I love traveling. I've been to 70 some odd countries, 73 in last count, although I do count all the Caribbean islands. There's probably 6 or 7 there. So I'm very particular with the countries that I count. But that really has, I've made it so that I can speak in other countries just to satisfy my love for traveling, as well as to educate some people that are outside of the United States, as well as, of course, many clubs in the beginning. There's a Dallas club that I did for several years, just flying out there and expos and so on. In fact, that's where I know John from, the previous speaker. We've shared the stage together many times. I've written 4 books, and mostly on trading plans, and dozens of industry papers on things that pop up in my head that I believe are important to put into print and run in magazines and so on. You've probably seen me there too. Most of it, again, building and running responsible trading plans has been most of that topic. This book still, this is 11 or 12 years old, still is available on Amazon and other places. And I'm coming out with a new book. They just sent me the publisher just sent me the first 10 copies. I didn't even tell David that yet. I should get it in the next 10 days. It's called Their Money, Your Profit, Cashing In on the Prop Trading Revolution. And if you're familiar with prop trading, then you know that you can trade somebody else's money and actually get 90% of the profit that you earn. And the reason they're able to do that is most traders have a hard time passing the evaluation. And then when they get funded, there's issues on staying funded. And we're going to go over what the big bugaboo here is and what you need to be concentrating on as a prop trader. So if you're considering prop trading or struggling with prop trading right now, this presentation is going to be very, very helpful to you. Okay, I am known for infusing the importance of the mental and emotional discipline in my talks and my writings, and actually in my trading plans. I came up with something about 20 years ago called nuances that I still put into trading plans. most of the plans that I've written have been for private professional investors, traders, floor traders, and so on, that have specific needs. There are no two traders really that are alike. And these nuances that I'm talking about, well, some traders are much more energetic. They kind of lack patience, as many retail traders do. They're constantly looking for the trade, and when they don't get a signal, they kind of make up a reason to get in when they really shouldn't be. So I have nuances that I've built into trading plans and ideas that can help the individual who has a particular distinction, mental and emotional distinction, so that it doesn't add any significant risk to the plan. They have a basic plan that I write for them, and then the nuances nuance that plan toward them without any significant increase in risk. So I always offer nuances with any plans that I take, whether I offer them like I'll offer a loaded gun. You've probably heard of it at the end of this presentation, that is built specifically for prop trading, as well as any other plans that I build. This is a room of 63 professional traders. It's not exactly the room. It's close to, it was in the 1980s. This picture was probably taken in the 90s. We didn't quite have this sophisticated desks. We had mostly telephones and a data feed. That's really all we had. But it gives you an idea of the kind of responsibility that I had in making sure that 63 professional traders did well by their clients. So we're trading client money, and each one of them had a separate trading plan that, you know, don't really care what it is. If they're making money for their people consistently, just keep doing it. I learned that simple trading plans work best by far, and that every trader is different. Every trader is different. There are no two traders alike. And when I offer loaded gun and people take advantage of the offer, I always make sure that I meet at least once with them one-on-one to understand how they trade and suggest some of these nuances to fit their mental and emotional challenges that they may admit to, into being able to run the trading plan without any hiccups. Because really, this is all about effective trading, whether it's prop trading or what have you, is all about making sure that you have a tested trading plan and that you follow that trading plan without hesitation. I want to talk first about game theory. I'm going to teach you a little bit about blackjack, but first, the definition of game theory is the study of mathematical models of strategic interaction. Now, I'm not saying that trading is a game, but it does involve game theory. So, you know, when you trade, you need to see yourself as a professional trader. So it's no game, but the way you trade and the way you act is really based on game theory and response. So, and let me just give you a little more of this definition. It's the study of mathematical models of strategic interaction. What that means is that we as traders are reacting to the rules that we're given and what we see on the charts. In other words, our interpretation of the chart and the rules that we are given from the prop trading firm to manage our trades. Those are coming at us, and game theory says that we as actors in the game need to respond to that input in a way to take advantage of what we're being, either work around it if it's a negative, or take advantage of what's coming at us if it's a positive. Okay, and I'm going to do this. I'm going to give you an example. I did make a living for about 18 months with my brother in Lake Tahoe through blackjack. This was in the late 70s and early 80s. I'm going to just show you a little bit about card counting. If you've heard about card counting, I'm going to show you how to do it, because because this is a great example of the rules. The house, they have the rules, and we as players need to respond in a way to honor those rules and take advantage, if we can, of the rules and veer them in our favor. Okay, here's a typical hand. Now, in blackjack, you are, I'm going to talk about, they don't do this anymore, but when I was playing, you could find a table where the dealer had one deck of cards in her hand, 52 cards, and she would deal a hand out like this, gather these cards, and then deal another hand from the same deck. Now, that's important, because knowing what's in her deck is a matter of seeing what was spent, what you're seeing here in this picture, and then deducing what is in her hand to give you the edge. Let me give you an idea. The other rule that you need to know is that a dealer needs to hit to 17 or high. She can't hold on a 12 or a 13, okay? Has to hit to 17, okay? So here's the way it works. Now, when you count cards, what you're doing is counting the 2s, 3s, 4s, 5s, and 6s against the 10, Jack, Queen, King, and Ace. What I mean by that is every time you see a 2, 3, 4, 5, or 6, you say in your mind +1. When you see a 10, Jack, Queen, King, when you see any of these 5 cards, you say -1, okay? And the reason you're doing that is if at the end of the hand, they turn them all up so you can see the cards. If at the end of this card counting, and I'm not going to count these particular cards right now, but at the end of this card counting, if you have a +3 count, what that means is you saw 3 more low cards with respect to the high cards. There were 3 more. So in the hand that is remaining, the deck that is remaining in her hand that she needs to deal out of, the deck now is 10 rich. It means she has 3 more 10 cards than those low cards, which means that she has a better chance of busting because she has to hit to 17. To know that means that we, in certain situations, will increase our bet for sure because we have an edge when she has to hit and the card and the deck is 10 rich. So you increase your bet, and in certain situations, you actually hold on a lower number and let her bust. Okay, that's what card counting is all about. I went through it pretty quickly, but if you look at this hand right here, you see 1, 2. So this is +1, +2, +3, +4. Right? No more low cards. +4, +3, because now I'm minusing. +3, +2. I'm sorry, +3. This is a 9, not a 10. +3, +2, +1. Okay, so now the deck is one. It has 1 more 10 card that wouldn't change the way we play in this deck, in this deal. But I wanted to show you what it means to count cards and why you get an edge. But this is not about card counting. This is about game theory, and what it means is that in prop trading, you need to understand the rules, and therefore respond with your trading plan the way you trade, with knowing those rules so that you can take advantage of it. Okay, I'm just going to go to the chat real fast and just see if you're with me here. Are you with me here? Just give me a, okay, very good. All right. Okay. All right. Here's what we're up against in prop trading. Let's get into the prop trading, what we're up against. And this is important to know, and you know it if you're prop trading. In prop trading, there's a 5% drawdown rule where the equity of the open trade equity, the loss of open trade equity is counted against you. And when I say open trade equity, I think you know what that means. If you put on a position and it's up $100, that's $100 open trade equity because the trade is still open. Until you offset that trade, what they call P&L, as long as until you offset that trade, it's just open trade equity. Okay, if it goes back down to the beginning, you put in a break-even stop and you don't take that $100, okay, that $100 is counted against you in this. I'm going to show you an example of that. But there's a 5% drawdown rule. And what that means is that when you start with a $50,000 account, and I'm going to reference a $50,000 account here because that's where I advise most people start. When you and there are many, many firms offering all my accounts are with Apex or Top Step, and but because they've been around for longer than most. When I started a few years ago, they were the biggest, and they still are. But there are other firms popping up. Be careful where you go. But there are a lot of good firms out there that you can do business with. But most of them have these particular rules. 5% drawdown rules, which means in a $50,000 account, you cannot have your equity below 47.5. Okay, so you've got a $2,500 give. Okay, that's a lot different than the room that you saw. There really wasn't a red line until they reached about 10%, 8-10%. In other words, it's much stricter with prop trading even than it was way back when I was running rooms like this. It's about twice as restricting as professional traders deal with. And as a commodity trading advisor myself, and after leaving that firm that you saw, I actually just ran accounts myself. And one of the few people that actually traded out of my home, ran millions of dollars in a fund there. You got to give yourself some room. Not a lot of room, because clients don't like to hear that they're down two digits. 8%, 5%, you can kind of handle that as long as you can come back nicely. But once you start saying 12, 15%, that's when you get money pulled and so on, and rightfully so. You really need to defend the equity that you're being responsible for. So this 5% drawdown rule is a tight rule going in, but the fact that they count open trade equity against you, in my example, I'm going to show you a specific example in a second, and here it is. Let's say you have that $50,000 account. You open your $50,000 account, whether it's whether it's funded or you're qualifying. $50,000 account. Your red line is 47.5, as I've explained. Okay. Now, let's say you put on a trade and you're at 51,000. You've got an open trade equity profit of $1,000, but you don't take it. You put in your break-even stop and you break even. Well, you're back to $50,000. If it's your own money, you can kick yourself. Boy, why would I mean, I gave a 2% gain away. Why would I do that? Well, I won't make that mistake next time. And okay, I still have all of my money. Okay, $50,000. Even though I had it, the 1,000, I let it break even. I didn't take it, but I still have my 50,000. That's not good enough in my room, and that wouldn't be good enough in prop trading either. So, although your equity remains at 50,000, that $1,000 that you didn't take is counted against you. And therefore, the red line is no longer 47.5, it's 48.5. I'm going to let that sink in. This is where traders complain. I can't believe they're trading open trading. They're counting open trade. Listen, you're asked to be a professional trader. And if you have trading chops, if you think you're pretty good at it, you do want to give this a try, because pretty good can morph into very good once you start seeing where you get knocked out, where you can improve, knowing that you're going to get 90% of the profit. There's a big carrot out there, and my people are collecting that carrots, many of them, and I want to show you how that's done with where you're focusing on. So I want you to understand the danger, how it works against you in this game theory of counting open trade equity against you. And because of this, we have to find ways to offset this disadvantage by prioritizing capturing open trade equity at or near its full capacity. So that when I look at a chart and I see this $1,000 trade happening, I see it going 800 to 1,000. When I see it getting to a resistance and support, I'm going to take it, and I'm taking that high point. I'm bringing in the $1,000. Now my equity is 51,000, and because I took it at the high of the move, because I used a limit order, I still have the red line at 2,500 below me. Now it's at 48.5 because the 2,500 follows you, but it's no closer to me than in my example that I gave you before. Okay, I want to emphasize, this is the one thing that I'm emphasizing. There is a book, and if you haven't read this, and you're an entrepreneur, or you're in your own business in any way, or you're a trader, you really want to read this book, okay? It's by Gary Keller and Jay Papasan, and what it really, there's one question that it's asking you to ask, and that is, what is the one thing that you can do such that by doing it, everything else will be easier or unnecessary? Let you look at that. I guess I missed a word there. That you can do. What is the one thing that you can do such that by doing it, everything else will be easier or unnecessary? And the answer to that in prop trading is focus on the red line, not on your equity. Focus on the red line, not on your equity. Sometimes I don't look at my equity, most of the time, till the end of the day. I know what's going on with it. I'm taking trades. I'm taking I take a couple of wins. I take a loss. I take a couple of wins. I know I have math degrees, so I know what's going in my head. But that's not where I'm focusing. I'm focusing on how do I keep that $2,500 distance from the red line. I have several accounts, and when I wake up in the morning, and the first thing that I do when I start trading is I measure the distance between my equity in these accounts and the red line. And when it's over 2,000, 2,100, 2,400, I know that I'm in really good shape. I've got a lot of room before I have any problems or stress or whatever. You need to focus on the red line. And the basic tool that you will use to focus on the red line and stay away from the red line while you're building your equity by focusing on staying away from the red line is the limit order. Okay, most traders don't use limit orders that I have coached. Most, what they do is they will sit there with their finger on the button, waiting and looking to apply a market order. When the market gets close to where they want and they get to the market order, they hit it. But they don't hit it a lot of the time because it's going in their direction. Maybe I want a little more. Then it comes down a little bit, and then they say, "Well, I'm a schmuck. I didn't take it. Let me wait till it comes back up to where I wanted," and it comes down, 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 and you're even. Limit orders, because we're focusing on the red line. So I can stop this presentation right now, and you've just gotten the most valuable piece of information that you probably didn't focus on. This is the one thing. This is the one thing in prop trading. And it's reasonable to say it's probably the one thing in most trading, but especially in prop trading, the limit order. I'm going to show you how to use it. The first example, I'm going to weave in here a little bit about Fibonacci. Okay. Well, first, let me say that until our account balance in a $50,000 account is over $60,000, until you have a nice $10,000 piece of room, the limit order is our #1 weapon for prop trading success. Because at $60,000, there is that red line I mentioned. It moves with you, but after you pass, I don't know why they make this 52.6. Let's call it 53,000. Once you pass 53,000, okay, that red line does not follow you. It stays at $50,000. Okay, it stays at $50,000. And when you're at $60,000, you've got a $10,000 cushion between the red line at 50,000 and that. So it follows you to a certain degree. Your first 3,000. When you open a funded account, you have 50,000, and your red line is 47.5. When you reach 53,000, that red line doesn't follow you. It stays at 50,000, and you continue on. And at 60,000, the red line is still 50,000. Now you can take your focus off that, open your trading up a little bit, and I can show you how to do that too. Okay, so I say 50.1, and in my explanation right now, I said 50,000. Don't worry about that. I didn't want to confuse anybody, so I made the numbers round. Okay, a limit order is an order to purchase or sell a futures contract at a specific price or better. Okay, you want the price that you put in. Okay, so here's how I utilize limit orders in prop trading. The first example I want to give you is in is using Fibonacci. Now I don't use it much. I kind of revived it since I told David that I would, I said I don't use Fibonacci um, or or Elliott very much in day trading, my day trading, but I have used it in the past, and maybe I'll start using it again. Well, boy, today did it work out. This is the copper market. Okay, this is from today's chart. Okay, this started at I started 7 o'clock in the morning, so I just got into this trade. Let me show you. This is the first trade I got into. Let me show you how I did it. When this was happening, okay, when this was happening when I got. Remember, I'm up at 7 o'clock. The market had come. It's coming down. Okay, I wanted a chance to get in it. These are moving averages. It's not important to tell you the ones we use, except for to say that, some people use the 50 and the 20. The idea is that you need a long-term moving average and a shorter-term moving average, knowing that the shorter-term moving average gives you where the market has a tendency, okay, as day traders in the short term. So when I take a short trade, I want the shorter-term moving average below the longer-term moving average. I'll just mention that. This is not a discussion about moving averages, although it's a big part of what I like to do and how we do it in loaded gun. But let me show you how. So what I did was this market came down, and when it started coming up, I said to myself, let me draw the Fibonacci line. So this is the Fibonacci retracement. You go from the top, and then you pull it down to the bottom, which was here. And now you're looking at the different Fibonacci levels: 76, 61, and I'm rounding here, 50, 32, and 38 and 23. Okay, I ignore the 23 most of the time. So let's take a look at what's going on here. Here's how I use it in prop trading. Here's how I use the Fibonacci. I'm looking for a retracement to at least 50%, okay, or to the 61.8. I'm looking. These are the two important lines, okay. What I will do is I will put in this particular case, I put it here at the first stop, because it's I don't want to breach the long-term average here. So I'm looking for the right spot. So in this measure, as the market was coming up, I put my limit sell in right here, and I don't get the high mostly. Actually, it ticked a tick higher, but I got the high on this. I put the limit order here to sell. Okay, I didn't put it here because it was above the long-term average. But I'm giving you these two arrows to show you the two places that I like to put the line. I'd like to put my limit order in. Okay, so I got in here, and look at this give up. It give up. Now I take my profit in this particular case. I put my limit buy-in here, because I'm challenging this. This could have been a double bottom. I'm not, because all I'm doing is focusing on the red line. And I know that if I have this open trade equity, there's a pretty good chance we're going to have some resistance here. It didn't happen, but it's a support level, and we could start going up. So I put my limit buy in here, and from here to here, I padded my distance to the red line. So this is a way to use Fibonacci with using the limit. This is the way I use it, the limit. And I didn't show you how putting the number in here, the limit twice, but right here is not where I would put it. Okay, I give you that red. I don't put it this high. When you're, from a mathematical standpoint, if we breach this 7-6 level, if we breach this, it's a bad thing. There's a higher probability that this thing is going to turn around. So I don't use that. I put my limits at these two places, and it's worked out. In fact, it not only worked out today once, it worked out again. Same chart. See this candle right here? That's this candle right here. It happened again. Okay. In this particular case, again, I put it in the 50. I got it. Limit order. As soon as I saw it turn around, I put my limit order into sell here. Got it here, took my profit down here. Okay, two really nice trades
using Fibonacci and using the limit in the right place. Okay. Again, you could have put it here. Again, I didn't because it's breaching the longer term moving average, which I don't like to breach in my system. And I certainly don't put it here because I never put it as high as 56 because that changes the mathematics of the reality of it. Is it going to come back? Okay. Now down here, you may be asking, why did I put it down here? There is there isn't enough to take here. If I get in here, I'm taking it that's enough to take to some degree. But I usually want more if I'm going to use Fibonacci, the Fibonacci number. And it usually goes to 50. These are the most common retracement areas, the 50 and the lower, the 50 here and the 62 or 61.8. So that's why I choose those. Anyway, you can see how well it works with Fibonacci. So limit orders, both ends of the Fibonacci technique here. So let's continue on to when I actually had this more officially done, but I threw the Fibonacci in because this is a Fibonacci webinar, and this is a damn good use of it and made me some good money today. Let's talk about the scalp. It's very important to scalp when you're at least half of what I do before I reach 60,000 in a $50,000 account is scalping, because scalping by definition takes your open trade equity at its high point, therefore adding to the padding between where I am, my final equity, and the red line. Okay, so the scalp is high probability. It's again, less that you ask for, the more likely you are to get it. It's like the first date. It's a bad example, but I give it anyway. You know, you can have a handshake at the door, and you'll probably, after a nice dinner, you'll get that for sure. You may get a kiss on the cheek. You can ask for that. They're not asking for much if it really went well and you feel that connection. Kiss on the cheek makes sense. You know, but asking if you can come in for a nightcap, that's a little too much. So you want the high probability finish, and the hug or the handshake or the kiss is really where you want to go. So the less you ask for, the more you're likely to get it. That's the general truth about the scalp, but it's even more important when you're responding to the game theory. You're responding to the rules that they give you in counting lost open trade equity against you. Okay, so it's now the scalp. The trigger that you use for the scalp's got to be tested. It's got to be reliable, and it's to move to early profitability. I call it frequent and reliable. You want a frequent trigger so that you don't press your issue, if you have one. Most traders do, on the want to be in the market on the patience piece. So if it's frequent and it's reliable, then you've got the right kind of trigger. We've got two frequent, reliable triggers in Loaded Gun, and we almost have a third one. It's not, testing is not quite done. But for an additional edge in your trigger, of which we have on both our triggers, you want it to pop upon application. In other words, when you put on the trade because of the trigger, you want it to move in your direction on the next candle or the second candle. You don't want to have to wait 3 or 4 candles. In fact, by 5 or 6 candles, the effect of a trigger has dissipated so much that it's almost negligible. So you need to find a way to reduce your risk and so on if you move out too many candles. So you want a trigger that moves within the first couple of candles, a pop enough to grab your scalp. Okay, so in this particular, this is from a few days ago. Let's say you took your position right here. This is actually one of our triggers. And we would be getting in at the beginning of this candle. We wait. This is the trigger. As soon as the candle closes, in just about every, really just about everyone that I've written in the last 10 years, I require that the candle closes, and there's reasons for that. We can discuss it some other time. But once this candle closes, I'm in on the next candle. Okay, I'm taking on 2 positions. Why? Because what I like to take on I like to use half of what I do. If you take on 4 micro contracts, 2 and 2, you treat them as 2 and 2. Okay, so if I'm taking on a position, 2 contracts, the first one is a scalp, the second one I call a runner. Well, the first one is going to be taken here. And I put an arrow here. It's not really
in an arbitrary place. The size of the scalp is really determined by, you'll understand after a while, but is really determined by the formation that we're dealing with, and I like the length of the candles that we're dealing with. A large candle, especially with relation to other candles, this is at least equal to most of the large candles here. You can expect a bit of a push. I would probably take it. I may take it a little bit sooner than that. But the idea is I would be putting in my limit order to take this scalp upon the pop. Okay, so that's an important. It's an important. I left this chart just clean and simple because this is what you need to do. I like to take on. Listen, I want big trades. I'm not here for scalps. I've never been a scalper in my entire career except for now as a prop trader, and I am an avid scalper, and I suggest that you become one too. Not totally. There are people who will just scalp and they can do very well. It's just that sometimes it can take a little bit longer where you want to go, but you can actually get there in many cases more consistently. So I like to let something run, but this chart demonstrates the fact that at least half of what you do should be in the scalping mechanism. Okay, so again, the second idea I want to relate to you as far as use of scalps, well, the third, I gave you Fibonacci, gave you the idea of scalping, is to capture equity at supports and resistance. I find that traders don't give enough credit to support and resistance because they know that when support and resistances are broke, that's when big runs can happen. Well, it happens a minority of the time. You know, I'm going to guess 25% of the time, maybe 20%. The vast majority of the time, supports and resistances hold up, at least on the first attempt. Okay, so always respect supports and resistances. Okay, now previous tops and bottoms are tested less than 50% to exceed the level on the first attempt. I say less than 50% because I want it to be absolutely right without any figures, but I believe the true number is closer to 25 or 30%. That would be using game theory against you, knowing that that something happens a minority of the time and you still do it by leaving a position in when you get to a support and resistance level. So some ideas about supports, it can be a double or triple top or bottom. Trend lines can offer you some support in certain cases, especially in very long trends. Bottoming and topping candle formation. I'm a big advisor to people about the hanging man, shooting stars at the top, hanging man. And remember, the shooting star needs to happen at the very top of a run and be clear of other candles. And the hanging man on the bottom clear of other candles. And the engulfing pattern is something that we've tested and used very well in certain situations and can make up some of it's really part of one of our triggers. So let's take a look at that same chart. So in the beginning, remember, we put on two contracts. Again, let's call it two movements. When I put on the S&P or the Nasdaq, I put on 4 micros when I'm dealing with beginning to trade toward what I need, that $60,000. I trade slow to kind of just continue to move. I want to get past 53,000 because that's when you can actually start getting paid, which is great. So you don't want to blow it, because if you blow a funded account, you got to go back to testing again, which isn't such a big deal anymore. I can teach you how to do that very quickly, pass in a day or two. But I want to show you what this is all about with the limits, how important it is. So the first limit you put in, as we mentioned, you measure, and we have specific measures that we use to take our scalp, or whatever measure you use to take the scalp, you take that. And if the market continues, that's your limit order here. You're going to put your second limit in here. Okay, why here? Well, you've got a top. This is a previous top. You've got some wicks. These are not shooting stars. The shooting stars have very longer wicks, very small bodies, and this is not clear. There's no way. But candle, wicks do have some impression on the top. But more than any of that, it's the recent high, And again, most of the time, you're going to come off that high as this market did. So you're going to put your first limit. Now, where do you put it in? Do you put it in? A lot of traders make the mistake of wanting too much. Again, you want that, you want the kiss, or you want the hug, or you want the handshake. And so look at some of the things that, so you have an engulfing pattern right here. You don't want to deal with these candles. You want to come in before this bottoming action occurred, or this topping action occurred. So I would put my limit right here, maybe even a little lower. What I want is to focus on the red line. And whether I take it here or here or here, it doesn't matter. Well, I'm accomplishing my main objective, as Kirk says, my what do they call it? The prime objective, I guess, or the prime directive, and that is do no harm. Do no harm to yourself, which means that you want to take because by putting in your limit in and taking your profit there, you are padding your distance here, from here to here, and again from here to here. You've got a beautiful padding. Yes, you could have made a little bit more money, and yes, if this thing continued, you could have made more, but that's not the objective when you're prop trading. Your objective is to do things that increase your value, your equity, but also, more importantly, because it's your prime area of focus, continue to pad your distance from the red line. Am I getting my point across to you? Am I getting my point across to you? Okay. Again, I'm looking. I always this one actually was something at the top of a run. This is a real shooting star, and as you see, it did wind up causing at least a sideways move here. And when you get strong moves, a sideways move can absorb the action here, as well as a retracement. I wonder if this Fibonacci trade didn't reach 50%, but okay. And now I'm looking at everything with Fibonacci too. All right, but I wanted to just give you and be aware of the 50% open trade equity level. What I mean by that is, in my example, let's say you got in here, okay, and you're still in your second position, and it came back up, okay. If you had waited for that second position to come down here and took it at the 50% level right here, you would have padded your distance from the red line here, but you would have been penalized with your distance here. So you would have been at the same distance from the red line as you were before, because what you took was equal to what you gave up. I think I explained that correctly. So I don't, be aware of, if you're being aggressive someday, and you're doing, somehow you're doing the wrong thing, but you did it already, and the market starts coming down, don't let yourself get below 50% of the open trade equity high that you had and didn't take. Because if you do, then you're going to be closer to the red line, rather than at least being the same level as when you started, even though you did add some equity. Hopefully you understand what I'm talking about. And the other thing I wanted to mention, and this is very important because this happens a lot, and it's not wear an orthopedic pair of shoes. It is when you approach the finish line, when you get close to the finish line, to the limit order. In my example, when you're coming up toward that, to that scalping area, or you're coming out up to the resistance, in this particular case, in my example, when you get close to that limit order and the market starts to hesitate, take it. Take it. You don't need the full scalp. You don't need the full move to the limit order. If you get close, if you're within 10% of that of your limit order, don't be greedy. You've got what you want. This is a great chance to just take it. If it gets really close, a couple of ticks, and starts moving down, I'm out. And you should be too. Because what is that doing? It's maximizing the open trade equity that you're absorbing and moving your distance from the red line. Okay, I think you understand. So the use of limits, real quickly: the scalp, high probability of open trade equity capture. You want to use the scalp as a part of your trading plan. Right before the support and resistance levels, you want to leave room to clear the wicks. Okay, again, just an example of when I see these wicks, I'm not taking much chance. I'm taking my profit right here, which in this chart seemed to work out pretty well. Okay, again, respect candle reversal patterns. If you're hesitating to take
at your limit. If the market is hesitating, you don't hesitate. You just take it. Go on to the next trade. You've accomplished your mission as a professional prop trader, and that's you have taken your equity at or near the high of the move. Okay, but you're going to need a frequent, reliable trigger to get this done. It's frequent so that it's not as not to test your patience, and reliable that at least 2/3 of the time that you put it on, you're going to get that pop enough to take your profit on the scalp, and then move your stop to break even on the remaining position. This is how you trade in prop trading, but you need a frequent, reliable trigger, and we've got two of them. So I want to present to you, and I know you've heard about it, the Loaded Gun Simple Trading Plan. Jeffrey Sasser says, I've felt burned out for a very long time, multiple systems, methods, and indicators. I like the Simple Trading Plan Loaded Gun because it's just so easy and yes, simple to understand and use. What Loaded Gun has given me is an edge. Again, that edge for the game theory in my trading. Sometimes an edge is all you really need. Many thanks for my wisdom and my knowledge and friendship. A little self-serving on that. Brian from Utah says, very good trader. I'm up over $10,000 in 10 days on a $250,000 funded account. Thank you, Loaded Gun. And Brian is up and away. Ted is one of my oldest clients. He's been with me for 7 or 8 years, even before Loaded Gun. He says that it's simple to understand, set up with easy to follow rules, works any time frame, takes me less than 5 minutes to look at all the markets I trade and make my plan for the day. After that, most importantly, follow the rules, join the small percentage of traders who are consistently making money like Ted and I, okay, he's from Arizona. I wanted to just show you real quickly what I also offer, and that's our trading room. I've never been a proponent of a trading room. I never liked them myself. Maybe that's why I never ran one. I never, to me, it was a lot of noise and whatever, but there are people that love trading rooms. And Dan DiMaria came to me. He actually bought our mental work. Again, we started our company 20 years ago, just helping traders with the mental piece. I got away from the building of the trading plan because the mental part was killing people. So I got into that as my focus. Well, Dan bought one of my original trading plan, my 10 or 15 years ago, and he called me last May and says, I want to run a trading plan for you. You don't remember me, but you talked to me 15 years ago. He's a former independent floor trader and member of the Chicago Board of Trade. I was actually the mayor of a suburb of Illinois, Morton Grove, for 12 years. He just retired this year. And after he retired, I think he hung up the phone for the retirement and he called me, said, let me run a trading room for you. I love Loaded Gun, and I really, it's really going to help a lot of people. And I'll let me and my son, who is collecting money on a consistent basis in prop trading, the two of them run the room. Okay, so you've got a trading pro and a room moderator for the disciplined trader with his son, Matthew. And people really love this room. And in my package, I give you 30 days free in the room before you get to pay $99 if you want to stay in the room, and which is very inexpensive, and you're going to want to stay, I believe. But I want you to experience it for a month, okay? Now, Brian says, I want to take a moment and let you know how amazed I am with Dan's Loaded Gun Trading Room. I booked 3,300 across 2 Val accounts this morning. I didn't expect this. That means he qualified for those. But I can feel myself borrowing discipline and patience from Dan. He's a very patient guy. He's a professional floor trader. He kept me out of trades I think I would have taken. The learning experience is incredible. This is fantastic that you guys have set up, okay? Dan is fantastic. His son is the future of all trading, probably. He's so good at it. And here's somebody else from Orlando, Daniel, different Dan. Loaded Gun Simple Trading Plan. I wanted to send you a quick email to let you know that the trading room is really fantastic. Dan and Matt are teaching us so much every day. I can really see that I'm approaching trading futures very differently. I have several profitable trades already just in the last couple of days. So you really want to get into this, okay? So I want to give you an offer that hopefully you can't refuse, because I really want to work with you closely. Again, I was the expert. Other people are doing it now, but I was one of the experts
I'm building trading plans specifically for individuals, and a loaded gun has enough nuances to make it flexible to fit you. I really want to be able to do that for you. So here's what I'm offering you. The total loaded gun simple trading plan. The rules fit on one sheet of paper. It's about an hour and a half of video. It's really two 45 minutes videos, including all the charts. It's a very simple trading plan. The reason it's simple, the reason I like simple trading plan, you saw how simple the chart is. That's the chart we used that I showed you with a couple of moving averages and technique. And what's important to know is that the more indicators you have, we also use a RSI on the bottom for position sizing, not whether to get in or out. But to get in, it's very clear and simple to get when to get in and how to take your scalp, and then how to let it run professionally. Okay, where to put your stops on the way up as it's going to your limit order. Okay, so the idea is that the more crap you put on your chart, the more you're asking. If you have MACD, why would you need an RSI or vice versa? They're both momentum indicators. You don't need towers, and you don't need all of these things are reasons not to take a trade. When you have two or three or four solid reasons to take, two or three really reasons to take the trigger appearing in the right place, that's all you need. Okay, as long as it's frequent and reliable and tested. So a simple trading plan is what you want. Okay, again, you saw the way the charts look. That's the RSI in the bottom for position sizing. Okay, now the nuances. I've mentioned nuances to you. We currently have 7 of them. You know, if you're somebody that overtrades or revenge trades, I've got a nuance for you that will help you mentally so that you can stick with this proven plan and not be your own worst enemy. So I've really weaved in some corrective action for you specifically, if you admit it to me. Otherwise, you're on your own. But in our one-on-one, and again, I'm giving you with this, not again, but I'm giving you a one-on-one private coaching session with me, as many as you need for 90 days. As many as you need. Now, I say that because there's maybe 1 out of 50 that do more than 2 or 3 sessions with me, because that's really all you need. It's a simple trading plan. I want to make sure that you understand it. I want to match some of those nuances with you, and then I want to follow up with you and make you a little bit accountable for our discussion and how we've stamped approval on your understanding the loaded gun simple trading plan. So the important part here also is that this private coaching does not start, the 90 days does not start until our first session. So what I advise you to do is go ahead and purchase at this very high, deeply discounted price that I'm going to give you, and then start looking at the videos. Okay, all of the videos and all of the nuances. It may take you 3 hours, and then I want you to look at some of our get-togethers. We get together every month on Wednesday, the last Wednesday of the month, and we get together and I take questions. I talk about some of the things I'm looking at. We talk about successes. I talk about struggles. Whatever it is, we talk about it. We share our experiences. Okay. So the private session does not. The 90 days doesn't start until our first session. So go ahead and look at the trading plan, look at the nuances, look at a couple of the past get-togethers, get the feel of why this darn thing works so well. And then have your first meeting with me. Okay, group coaching once a month, as I mentioned, 1 month free in our trading room. So again, that clock starts when you sign up for the trading room. Okay, you'll get the first month free. And here's my personal guarantee. I'm so confident that you're following the loaded gun simple trading plan will result in you getting funded by a prop firm so that you risk their money and not yours, and we still receive 90% of the profit you generate. Just share your trading experience with me, that you followed the rules and it didn't work for you, and I will refund your purchase price plus $500 for your trouble. And I want to see you paid. Why do I offer $500? Because it's not going to happen. If you follow the rules, you'll do very well at this. This is my commitment to you. Okay, you have the guarantee in case I'm full of it. Okay, so currently offering, if you look at the site that I'm going to send you to, it's offered right now at $24.97, and those are being purchased at that price, but without the trading room. I don't offer the trading room. You do get the coaching for 90 days, and you do get the monthly meetings, but you don't get I'm giving you I want you to experience what winning is. So I want to give you that trading room. But there's a limit of 10 traders. The reason is because of this piece right here, the coaching piece. I don't want you to have to wait 3 weeks to see me. I only coach on Tuesdays and Thursdays, and I want to be able to see you as soon as you want me to see you. So I don't vary on this. So first 10 traders are going to get, if you're not the first 10 traders, you'll get a waiting list banner, and you'll probably get in the next week or two, because there's always some people real quick that look at everything and then want to meet me. So here's the offer for you: $797. Okay, so you're getting a $1,700 literally discount on this. $24.97 one-time investment of $797. Just go to theirmoneyyourprofit.com and use the coupon code LIMIT, because that's the subject of what we're trying. If I never see you again, somehow you need to put limit, or you need to start using limit orders if you're a prop trader, because this is the key. This is the one thing. This is the one thing. The red line, stay away from the red line, because when you get within even 1,500 of the red line, 1,000 of the red line, you start unwinding. You don't want to do that. Stay away from the red line. Use limits in some of the ways, and we have more ways to do that in our course, but I just want you to be very cognizant of where your focus should be. So $797, first 10 traders really want to help, and that's why I put together a package like this. And I really want you to learn how to win in the trading room too. You can see winning going on, and really a lot of traders, many traders have a habit of coming to the table every day and saying, I hope I win. I had a bad week. I hope it turns around. All the wrong ways to sit down. Today, I'm going to win. And when you see winning happening, much more often than a losing day, when you see 4 winning days and 1 small losing day, when you see that kind of action, you start realizing this can really be real for me. So I really want you in that trading room also. Anyway, love to have you. Don't think we have, maybe for one question, we have a chat. I see a number. Hi, Anka, thumbs up. I think that was for me. You're back to the computer. That's good. So I see that you're back, because you put up in the chat what they need to do. I don't see any questions here, which means that I've made a presentation that people understood 1,000%, either that or I lost them totally, one of the two. But I'm here to help. David, thank you for the opportunity to present and to give prop traders really a window of opportunity here to actually start collecting money on a consistent basis. So thank you again.